Hello, welcome to Headway Capital's presentation of The Power of Passive Income, The Path to Financial Independence, hosted by me, Steve Nagami, member of the Investor Relationships team at Headway Capital. Before we jump into it, if you want these slides, text me 281-559-7061. All right. Also, a quick disclaimer. This webinar is for educational purposes only and should not be considered as legal or accounting or investment advice. The information in this webinar does not represent an offer to sell or a solicitation of an offer to purchase an investment or security. Please consult with your attorney, financial advisor, CPA for legal matters, investments, and specific tax questions. A little bit background about us here at Headway. Headway was designed to build and protect wealth for busy professionals. Our goal is to provide investment opportunities for you to give you the freedom to matter for the things that matter most for you. Our team was founded here by Sid Shamin and Anan Omar back in 2017. Before 2017, they had an extensive single family portfolio before building this extensive portfolio of multifamily housing. Um, Also here is Brian, who has been in multifamily since 2019 and joined Headway in 2022 to educate and help investors grow with Headway Capital. And here, me, Steve Dagami, I joined Headway just this year. I've been investing with Sid since 2019, and I was always impressed with Sid and the company and how they operated, and have been fortunate enough to help new investors learn about multifamily investing also. So I'm really excited to be here. Here at Headway, our core values are transparency, integrity, lean operation, accountability, and especially investor first. All these really wrap around putting our investor first, maximizing their returns so that you can do what you need with the money that we provide for you. Here, the Headway difference: we own we have over $440 million of assets under management. That's including 200 or 2,800 units under management, um, and returns 25 to 30% annual returns with 500 active investing partners. Here are some testimonials about Sid and our company. And really, let's kind of jump into it right now. So before we actually get into what passive income is, I really want to tell you why you need passive income, right? The why before the what. And really having enough passive income will give you choice. You can call it freedom, you can call it self-determination, you can call it options or empowerment or independence, but really call it anything you want. It's really just having the choice to do what you want with your time and money. I don't really want to get too far into the philosophy or psychology of money, but at the core, we should use it to obtain things to make our lives better. And one of those things is having a life full of choices that we want. Really having enough income to choose what you want to do with your life, your time, and your family, and being able to choose when and how you work or retire. Being able to make all these decisions instead of having the decisions be made for you. As we get older and we climb up the corporate ladder or pyramid, there really are less jobs at the top, right? We have the CEO down to the C-suite, down to the directors, and to down the pyramid to the managers, and really, it's really kind of funneling up, and there are kind of less and less jobs as we get older for these higher paying jobs that we are working. And, I just talked to a director of IT. He's been out of his job for 9 months. He's been looking for a job. He can't find one. He needs the money. He's in his early 60s. And really, the choice has been kind of made for him. I don't know if he'll be able to find a job, right? Or if he does, it's going to be with less pay. And I also have another manager um, that lost their job about 2 years ago, and he's still looking. I last heard he's had to sell his house and move to a more affordable area to live. And uh, now I know you're here to learn how you don't have to be concerned with these situations and be cornered in this situation, so you can have better choices when life-altering events might happen to you. And for most of us, having these choices only really happens if you have reliable passive income with high enough returns, which I'll talk about shortly. Now, when we kind of first talk about passive income, we kind of see the two major routes, which are stocks and real estate. Um, you might know them fairly well, but I kind of want to get into each pros and cons of each one, and also beyond that, there's other passive incomes like private equity or having owning a passive business, which both those require quite a bit of money to get into. And really a passive business really isn't passive. There's always something you have to do. I would say that owning a lot of real estate properties and managing it by yourself is really like owning a business, but we'll get into that in a little bit. So getting into the pros and cons of each uh, most general passive forms of passive income. Starting with stocks, the pros. Let's get into it. Liquidity. When we invest in our retirement accounts, the money is maybe not as liquid as we think, right? Our retirement accounts, we put in there and they stay there until we're 65. Um, you can change the investment types, but the money is generally stuck in that retirement account. And so most stocks and ETFs portfolios really generate about 8% return on the high end, right? With a good balance of stock, ETF, bond portfolios. And so getting into kind of the cons, the fees, I'm sure you've seen some graphs on how 1% can dramatically affect your portfolio. So, there's a lot of, I want to say, hidden fees in your 401k that you might not be seeing. And maybe they're not quite 1%, but really it does kind of eat away at your returns. And then also volatility. Stocks, right? Day to day go up and down. It's hard to kind of follow and predict what's going to happen. Obviously, we know over the long term they go up, but day to day, it's kind of maybe non. It's maybe kind of nerve wracking looking at your portfolio, and really, um, also, these are non tangible assets. They're what's called paper money. They're not real, but they're priced on based on what a market thinks the company should be worth years in the future. And really, the income part, the passive income part of the stock portfolio is the dividend or maybe the bond yield. And for example, they're pretty low, right? S&P 500 is 1.3% right now. I guess with interest rates being high, our T-bond rate is about 4.5%. So yeah, that's pretty decent, but that could change over the future. So let's jump into real estate, pros and cons of real estate. So pro for real estate, it's a brick and mortar asset. It's real. You can touch it. It exists. Uh, there's the tax benefits only, especially for real estate, which is depreciation. And right now we have what's called accelerated depreciation, which maybe we can talk about at a later date. And the cash flow is generally about 4 to 7% on a good investment. I would not invest in property that doesn't make money day one, that doesn't cash flow. And I think that's where most people get in trouble, losing money when they're seeking appreciation. So on these investments, on a good real estate investment, you're probably looking at a 20% rate of return. So what's the con? Well, number one, the uh, real estate is mostly liquid, which means it takes time to buy and sell. right? The market is imperfect, and there's not always a buyer to match a seller, and so the prices can change, which maybe is actually a good thing for a skilled investor who knows a market and can use this to their advantage for better pricing. And another con is even though we know that a property is turnkey, which means you could just buy it and rent it the next day, you still have to deal with a lot of things, the renters repairing, and what I'm saying is receipts. Um, for renters, you have to find a renter. You have to put somebody in your property, and then you have to deal with the issues that they have. Maybe they're a bad renter. Maybe they tear up your property. Who knows, right? And if you hire a property management company, they might have 50 other properties they're trying to manage, and yours might be last on the list to fill if you have a vacancy. Um, for repairs, there's always something to fix. Like you always get that midnight call from somebody to repair something. I just got a call the other day for a plumbing issue. I have a condo locally here that I had to deal with, and yeah, it's always something you got to deal with. And then receipts, collecting all the receipts and organizing all the deductions for your tax preparer. I'm not sure about you, but with the property that we own, I spend way too much time trying to make sure I keep all the records straight, and then worrying about did I maximize all my deductions. Having the personal real estate is great for cash flows, but it's not really truly passive. It's also difficult to scale. Again, I own a condo, and yes, it's really relatively easy to manage. I did have to deal with this call, but it's few and far between, and we're lucky to generate about $200 a month when it's occupied, which is nice. But really, to make this work, we're going to need 20, 30, 50 properties. That's kind of a lot, right? And it gets hard to scale, and managing that many properties, that's really a second job. Also, dealing with vacancies, right? When your property's not being rented, you're losing money. You probably have a mortgage, and that's really going to hurt your bottom line. So, bottom line, I'm kind of a proponent of both having stocks and real estate in my portfolio. That's called diversification. One investment is not correlated to the other, which is great. Real estate has a higher projected return, which is crucial if you want this higher or the higher rate return leads to the ability to have choice and freedom that I was talking about earlier. And both have their benefits and should be in your diverse portfolio. But I wanted to show that real estate kind of has its drawbacks, but I also want to show that there's a way to own real estate truly passively, and we'll get to that right now, which is really owning real estate through multifamily passive partnership. Um, so let's talk about really passive real estate. Okay, so this picture is of one of our newly acquired apartments in Houston. It's called Shadow Creek. And as you can see, it's a real asset. You can go out there, you can touch the buildings, the pool, the playground, it's all out there. If you invest in this deal, you're an owner of the land, the building, the refrigerators, the roof, the parking lot. It's all there. You own it. Um, and you also get the benefits, which is only seen through real estate, which again is depreciation, and as well as normal business tax advantages of write-off, or sorry, of expenses and write-offs. Um, and with this project, we projected a return of 20%. Really, it's 23.3%, but we are projecting a pretty high return. And to address the cons of owning real estate, uh, we've said number one, it's illiquid. But as I said before, a good owner can use that to their advantage and buy a property at a good price and sell at when it's advantageous. And then as a investor in the property, yes, it's a long-term investment, and it really should be treated as much. And you should not put your money all in on these investments. And you should have your rating day fund so that you don't have to draw from the investments and you don't need the money from them in the short term. And so when the sun shines on the properties, you can profit. the investors in these properties also do not have to deal with renters, the repairs, or the receipts. Headway Capital handles all that for you. We vet the renters, we do the repairs, we rehab the property. At tax time, you get a K1 and you give that to your CPA, and that's it. You don't have to do all the expense reports and everything else to make sure that you're maximizing your deductions. And scalability is relatively easy. Um, you can buy into large scale apartments, and I recommend to look for ones that are 100 units or above, where vacancy is priced into the revenue models and it still cash flows. And you can keep investing in multifamily apartments without the hassle. Again, the renters, the receipts, all the things, all the legwork that you have to do. And you can, um, even diversify by buying in different locations. And this is where you can generate what's called mailbox money, um, which is an old term where you can just walk to your mailbox and pick up a check. And now, everything's done electronically through ACH transfers. So it's directly your bank account, which makes this truly a passive investment. So, next to your having your past investment is really making sure they compound and reinvesting. And really the statement of compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. I don't know if you recognize where this came from, but it's often attributed to Albert Einstein, but it's actually a misquote. Just wanted to make sure that everybody knows it was misquoted, but it doesn't mean this is untrue, right? Having our investments compound, that's really where the magic happens. And but the beyond that is having your compounding and reinvestments occur at higher rates. And really what I want to show in the next couple slides is the difference between investing in the S&P 500 bonds versus a more diversified portfolio of stocks, bonds, and commercial real estate. So here's the first illustration of just stocks and bonds. Okay, I pulled this from Schwab.com on their retirement calculator, and you can find the same one by looking at this link at the bottom here, or by just going to their website and searching for it. So in this illustration, I'm taking I'm going to use this illustration similar to on this page and the next slide, but having somebody who's 50 years old at a retirement age of 65, having a moderately aggressive portfolio, which is 80% stocks and 20% bonds. This is by Charles Schwab. A high income of 300,000 K, which the professionals say that you should have at 50 years old, you should have $1.8 million saved. Um, and then also a 10% savings rate of 30K. So continually saving 30K throughout um, your career. And this is with Social Security at retirement. It's calculated with the annual spend rate of 80% of your income after retirement. And with this, we see that we're short. Actually, it's $1 million. I think I played with this a little bit a couple times, but we're actually short $1 million at the retirement age of 65. And so, they're saying there's a couple ways you can catch up. And one is work 3 more years, right? Change your retirement age to 68, or increase your annual contribution to $64,000. So doubling that contribution to like 20%, over 20%. Um, and then reducing your spending, right? Having less money in retirement. So instead of having about uh, $260,000 per year in retirement, you spend 200,000 per year. So that's significantly less for your retirement. Now let's look at a different illustration with having stocks, bonds, and passive real estate in your portfolio. So again, retire or your current age would be 50, your retirement age is 60, income 300,000, savings 1.8 million, same savings rate 30K. And then this is again with Social Security and annual spend rate of 80%. Now, what happens here with this 75-25 stock real estate portfolio, I've increased the returns to about 12.5%. That's blending the 8% from stocks and uh, the 20% from real estate. And we see this allows us to retire 8 years earlier. So retirement age of 65. This is, your retirement savings should run out at about 101 years old. So this is uh, 8 years of difference, which allows you to have 8 years more of choice of what you want to do with your life. Um, so I think if you haven't played with these calculators before, this is a great way to figure out where you are and see where you need to go and what investments you need to get to the path that you want to be at. Um, Sorry, I skipped one thing. This calculator was on Forbes.com. This is their retirement calculator at Forbes.com. So if you want to use this calculator to be able to adjust your rate of return manually, yeah, you can use this calculator too. All right, so putting that all together, right? So one, knowing that key takeaways that passive income gives you the choice to do what you want for you and your family, right? And really generating higher rates of returns and higher passive incomes really allows you to do more. And the other thing is that if you've made the right investment choices, the right ones, the ones that the professionals tell you, the big Schwabs and the um, well, I guess TD Ameritrade is gone, but these big investment firms tell you to invest in, you still might fall short of your financial goal. They outlay these things and it's still short. Um, and really, again, diversifying with real estate can increase your returns. Um, real estate has a historically better return than equity markets overall. And as long as the property cash flows, the risk to that investment is relatively low, and the cash flow can be used today or reinvested and compounded for future returns. Also, passive income through multifamily is a truly passive investment. After doing some research, setting up the investment, just all you have to do is wait for your distributions and keep update on how the property is doing, and then apply the tax advantages by just giving your CPA the K ones, and then you just wait for the sale of the property. It's pretty easy. So next steps. I highly suggest you look over your financial situation, right? If you haven't done this in a long time, maybe you have done it a while ago. Actually, to tell you the truth, I hadn't looked at mine for a little bit, and I was kind of surprised where I was at. But yeah, look over your financial situation. Does the model show that you'll have enough for retirement? Um, do you want to be, where are you in your security? Uh, and And do you want to be at the place where you can make the choices you want to do with your money in life? And then also if increasing your investment return is something you want to do, it seems right for you, give us a call and we'll talk about it. Um, we'll see what we can do for you. Another investment vehicle we actually have, which I'll talk about in a little bit, is a debt fund, which returns 8%, which could be a great option for you if that's where you're at. And then really, if you are already an investor with us, keep looking at our newsletter and watch out for new properties. We're looking for deals all the time when we're really looking for the best deals to maximize the returns for you guys. So to that point, if you want to join our private investor club, you'll gain access to in-person events only and property tours, uh, our webinars, and um, our investment opportunities. And to join, you need to submit an application, talk to Brian Siderai, and be an accredited or sophisticated investor. Sophisticated investor means that you have the financial means and understandings of the risks involved in these investments. And accredited means that you have $1 million of net worth, not including your primary residence, or 200K of income as a single person, or 300K as a married couple. So to apply for our investor club, just scan this QR code and you'll be sent a link to our website and you can fill out the application. It's easy and we'll schedule a call with you and we'll go from there. So our income fund that I just talked to you about, well, let's just start from the top. What is a real estate income fund? It is a private lending business that originates short-term loans for residential real estate investors. You might have heard this as hard money lending. And so here we have these hard money loans, and we have secured a first position lien, which is held by us. So if a property defaults, we own that property. We're the first persons to own that. We're the first people to own that property. And since inception of the fund, they've funded over 1,300 loans, which is over $270 million. I think actually that number is now, let me look real quick here, $350 million. And the borrowing demands is really strong. It says $8 to $12 million. Last month they funded almost $10 million. So, right in the middle of those loan amounts. So we have a dedicated managing partner that oversees all this and makes sure these funds are on the level. So our managing partners, you can contact Sid or Brian or I and get more information on how the fund works or any other questions you may have. So, for a quick investment summary, again, $100,000 investment gets 8% return. You can kind of look at those numbers right there. But a couple of things that are pretty important. The returns can be compounded monthly if you leave your money in there, or if you need the money, you have a 90-day liquidity option, which is pretty fantastic if you really need to see that money for that return. So if you're interested in this fund, please click or please scan the QR code, and again, it'll bring you to an application, and we can schedule a call and talk about entering into the fund. Oh, shoot. If you have any questions, please send us a text to 281-559-7061. I forgot to ask for questions, and let me see if I can see where if anybody's actually asked a question on the meeting. And no, unfortunately not. We don't have any questions right now. But if you have questions later on, just send it to us and we'll get back to you. All right. Appreciate you guys' time. Thank you for listening to us, and I hope you guys learned something. All right. Have a great day.